So I'll just be straight with you. The credit game is about to change forever. The last few decades have consisted of banks relying on older scoring models to determine whether you were approved for business funding or denied for business funding. So in this video, I'm going to break down what these two scoring models are, what they do, how they act, and why the time is going to be now if you have good credit and want to try and fund your business as soon as possible. So let's go ahead and get right into the video. So we are at my computer now, and I want to actually go over what has just happened. Okay, so on July 8th, 2025, U.S. Federal Housing FHFA announced that lenders will be able to use the VantageScore 4.0 scoring model or classic FICO via the tri-merge credit report requirement. Fannie Mae and Freddie Mac are working closely with FHFA on next steps and remain committed to a smooth transition for our industry partners. So guys, again, this is for mortgages, what this is talking about right now, but I'm going to apply this to business owners and how this is going to affect funding going forward. But VantageScore 4.0, that's very common for like Credit Karma, some of these other third-party sites like Credit Sesame and some of these other ones. And so VantageScore is, the thing with it is no lender was really pulling it. But now mortgages are going to be using VantageScore 4.0 and FICO 10T to be able to determine if you can get approved for a mortgage loan. Okay, so this is directly with like Fannie Mae and FHA. Okay, so this is huge. This is huge. VantageScore has not really been used by most lenders, and that is going to be changing. So guys, you definitely want to pay attention because I'm gonna be breaking down how these scoring models are actually going to be working for you and against you in some cases. So let's kind of talk about, let's get VantageScore out of the way really quick and dive into that. So VantageScore 4.0 is the first and only credit model to use trended credit data from all three major credit bureaus. This allows to look at your financial habits over time, like consistent payments or how you pay down debt, instead of just a single snapshot, giving lenders a more complete picture of your credit behavior. Now, I want you guys to keep this in your brain because as we go to FICO 10T, you're going to hear this start to sound familiar. Okay, so let's break down what FICO 10 and 10T is actually going to be. Now, FICO 10's been out, FICO 10T's been out, but I want to break down what this is because, lenders are probably going to start using this here in the near future. So it says your score is most likely to drop when using the FICO 10 scoring models if you took out a personal loan to consolidate credit card bills, but now your credit card balances are up again or appears you have applied for additional credit. Secondly, you are using credit cards to get by and you just can't seem to whittle the balances down or balances are growing. And thirdly, you have missed a payment. The penalty for going 30 days past due will be even harsher than it is under previous FICO scoring models. On the other hand, it says some people could see their scores rise by 20 points or more. Your score is most likely to rise if you have been penalized for occasional high balances. So basically what this is trying to say is for people that carry balances, if you consistently over time have high balances on your credit cards, this new scoring model is going to ding you severely for that. But if you show that you've had high balances and are paying them down in a good amount, month after month and month over month, then this new scoring model, versus FICO score 8, which is what most lenders are still using, FICO 10 and 10T is actually going to reward you in a greater fashion for doing that. So that's one of the big differences here with these different solutions. So now I want to kind of go through and break down what all this is kind of going to be looking like. Okay, so what the new credit score changes mean for you as a business owner. So first, approvals are no longer based on snapshots. With classic FICO, banks judge you off a single moment in time. Now, FICO 10T and VantageScore 4.0 use trended data, meaning they track your spending, payments, and utilization over months, not just one day. Translation, if you've been running up balances and paying late, they'll see it. So again, guys, FICO score 8 just didn't do this. If you had super high balances last month and then paid them down before the statement close date, or basically before the statement close date, and then it reports, FICO 8 doesn't ding you for that. Your utilization is just going to drop and everything's good. But with these scoring models, if you've been doing that, your scores is going to reflect that, right? And so lenders are going to be able to see, again, as it said, not a snapshot in time of right now, is going to be able to go back and see a trend of what you've been doing over time. So that's why, again, when they start implementing this, and I'm not talking about for mortgages, I'm talking about traditional banks on the business side for funding, when they start implementing these guys, it's going to be a huge change. It's going to be a drastic change. Okay. So secondly, more weight on how you manage debt over time. No more gaming the system with quick fixes like authorized users or rapid rescoring. These models show lenders how you actually manage credit month to month. And you've seen me talking about this, guys, a whole bunch. Authorized users don't really work like they used to anymore. And so translation, a 700 score today may not hold the same weight as it does tomorrow or when they start implementing these new scoring models. Okay. Third, risk industries and BNPL habits get exposed. And so BNPL is buy now, pay later. If you don't know, Vantage Score 4.0 also pulls in new data points like buy now, pay later options. If you've been stacking short-term financing, lenders will see patterns that old models missed. Example, somebody that we hopped on a call with trying to join our mentorship program that had a 720 score, which was safe, but because he carried balances month to month under 10T, he would have been flagged. Okay, would have been flagged how he currently is today versus what they're going to be doing in the future. We were able to get him funding before that rolled out, obviously, because he decided to act now. But let's get into the fourth thing. Deny before you may get another shot. And this is more of a positive because new models mean new criteria. Some businesses who've been denied will suddenly look better, but only if you've aligned your credit profile and business structure correctly. Translation, this is the window to get in before stricter rollout phases come out. Okay, and that's going to be the story of this video, guys. You want to learn this stuff now and see what they're about to be doing so you could be a step ahead of the game. And number 5, regulators and politics are fueling the shift. Trump's fair banking order, which I made a video about a couple weeks back, is pushing for more fairness in lending, which is one of the reasons why VantageScore finally broke into Fannie Mae and Freddie Mac after decades of FICO's monopoly. Translation, lenders are being forced to modernize when they didn't have to previously. So let's get into why this matters for business funding. More scrutiny equals less room for error, but also it means more clarity. Approvals are based on real trackable data. Banks are under pressure to adapt. Entrepreneurs who move first will win the largest approvals. And we've already been seeing this with businesses that we work with in our mentorship funding program. But here's the truth. They still want 700 plus credit scores. Low utilization is non-negotiable now, even more so than it was previously. No negative items. A properly structured business that matches your credit profile. Okay, if you meet those requirements, this is the perfect time to stack 50K to 100K plus in funding before these new models tighten access. Okay, funding practices that work right now. So profile alignment protocol. This is optimizing your personal credit utilization and data points that Vantage 4.0 plus FICO 10T track. If you're going to be trying to get ahead of this, you want to start this now. Business structure and stack, LLC, EIN, bank accounts, all compliant, consistent, and lender ready. Multi-bank funding play, apply in the right order so approvals snowball across multiple institutions before the stricter rules hit. All these things, guys, you're going to want to really hone in on as you're trying to fund your business, because, again, this stuff is going to be coming down the pipeline. I'm telling you about it now. So don't be shocked when these banks start using FICO 10T in the next coming months for underwriting, because it's only with mortgages now, but trust me, it's going to be coming to all other financial products coming soon. So here's the key rollout windows. Within 2 to 3 months, FHFA is alerting lenders to begin integrating Vantage 4.0 and FICO 10T. Around 4 months, banks start piloting these models and approvals may look very different. And by month 6, full rollout begins, meaning old tricks won't work and only the best prepared businesses will slip through. What this means for you: these next few months are the rare window where banks are in transition and businesses with strong credit and proper structure can stack funding before stricter scores become the norm. So again, if you are trying to get business funding, your time is going to be now, especially over the next, I'd say, between now and like 3 to 4 months. This is going to be your time. Okay. It's definitely going to be your time. You want to get in, get your funding while everything is kind of still how it is now. And I would say right now it's probably gonna be easier to get funding versus when they start implementing FICO 10T into a lot of their underwriting criteria, because a lot of ways people manage their credit is just not going to bode well for FICO 10T when they decide to start using that universally. Okay, so I'm telling you guys now, if your goal is to get funding and you're ready right now, this is your time. Okay. Now, if you already have a 700 plus credit score, you're tired of the guesswork, you see stuff like this coming down the pipeline, you've been doing it on your own, and you want to just skip all this nonsense. You don't want to learn how to manage this FICO 10T and all these other scoring models, and you want to just get our help, have us build you a custom funding strategy from the ground up, use our vetted contacts to be able to fund your business in under 30 days, go ahead and click the link in the pinned comment or in the description. You'll be able to hop on a call with us, sit down, analyze your business, see if it makes sense for you to join our mentorship funding program, where again, we can build you a custom funding strategy. You don't have to worry about all this nonsense because we can build it all out for you and then connect you with some of the best banks that are going to make the most sense for you and your credit profile and your region of the country that you are in. So if that interests you in any way, go ahead and click the link in the description or the pinned comment. You'll be able to hop on a call with us and go ahead and see about that. But I hope you guys enjoyed this video. Go ahead and smash that like button if you enjoyed today's content. Subscribe to the channel, hit that bell for notifications so you will be notified every time I drop a new video. And if you want to learn how I was able to get over 500K in business funding leveraging my Omni growth strategy, go ahead and click the video that you see on the screen right now. It's going to take you to a recent video that I just did where I broke down my entire 3-step Omni growth strategy. So you can literally just steal it from me in that video and see exactly how I did it. So if you want to learn that, go ahead and click the video on the screen right now.